Hello, everyone. It is absolutely good to be here. My name is Brent Moores, and time for long options. I'm joined by Connie Hill, who's helping me out in the chat. If you're watching live and you have questions, feel free to type those questions in the chat. And if you're not watching live, that's okay too. We love you anyway. We're just glad to have you. You know, the last few weeks we've obviously a lot of volatility in the market. We've talked about some example trades that have had very high potential gains and also high potential losses. This week, I want to dial it down. I want to talk about small potential gains, smaller potential gains, and smaller potential losses as well. Taking small wins, so to speak, swinging for base hits instead of home runs type trades here with long options. We're going to do that in just a minute, but let me just mention this first. You can follow myself or Connie on X at Brent Moore CS, at Connie Hill CS. And also, options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is provided for educational purposes only. For the sake of its simplicity, the examples in this presentation do not take into consideration commissions. All investing involves risk, including risk of loss of, with a long option, you risk the entirety of whatever you spend on that long option. Past performance of any security or strategy does not guarantee future results or success. And there we go. These are not recommendations. These are examples. Let's take a quick look at the markets. Before we get to our subject at hand, I want to talk to you about taking these smaller wins. Specifically, though, I want to talk to you about ATRs today, using average true range to try and help you in that regard. We'll do that in just a bit, but let's just take a quick look at the market here. Wow, I mean, you guys have seen the pullback. We've had a bounce, and this is obviously giving some people some hope here. We tested some lows on, let's see, this was yesterday, right? So this was Monday. Today's Tuesday right now. You may be watching this on a recording, which is why I'm mentioning this. Question is this going to be just is this a bear flag? And we're just going to hit lower lows? But at least this is better. This is what we were hoping for, is that Green Day bounce. Today was opened up a little more optimistic. We're down near the lows of the day there. So, we'll see on that. There's different ways to measure that. But, part of it is we do have more economic data coming out this week that can affect things. Obviously, the biggest thing is news surrounding, tariffs and stuff like that. But has the market sold off enough here? Well, I don't know. We'll see. If we are doing trades, we can do bullish trades or bearish trades. Typically, well, not typically, right now in the market, there's just more bearish stocks out there. More stocks, if the market as a whole is doing this, more stocks individually are going down. So it's easier to find bearish examples. But when we are doing those bearish examples and we're looking to do, say, a long put on those, long puts are used when you are bearish on the stock. And you look at something like this, sometimes you're wondering, well, where should my target be on this? Where should I place a target for my bearish trade? And you can do this, and one way to approach on something like this, where people will look at, say, a flag pattern, where they go, well, here's the flag pole, kind of maybe going sideways, and they take the length of that flag pole and they add it on here, and they go, well, my target is down here, okay? Which is absolutely fine. It's a valid way of doing it, but that's also a very ambitious target. Okay, that's a big target there. Now, maybe you don't do it that way. What are other ways to find targets? Well, other ways, maybe past support levels. Maybe that support level becomes your target. Okay, I know my line's not super straight there, but you get the point. Maybe that target all the way down to 170 is too big of a target. Okay, and you want to take a smaller potential gain. Other ways of finding targets, maybe use Fibonacci levels. You can do that. I don't want to delve too far into that because I don't want to get sidetracked, but sometimes people will go here, they'll get their Fibonacci retracement on there, and they'll do this, and they'll go down. They go, oh, I've got a Fibonacci level down here I'm going to use as a target. That's fair enough. You can do that. We have webcasts on Fibonacci targets that I'm not going to do right now, go into right now. But my point is, sometimes those targets can be a long ways away, but maybe you don't want to go so far away. Well, that's where we're going to bring in the ATR. ATR stands for average true range. It's a measure of market volatility. It's a measure of, on average, over the past 14 days, how much a stock has moved in a given day. You can do that by going to your studies. It's just under ATR. You can add that on. The default's 14 days. Of course, you can change that if you want. I'm going to throw that on that chart here, and we can see our ATR here. And I'm going to go back to AbbVie in a sec. We'll go back to that one in just a minute. But let me just kind of do just another stock as an example here. And, just kind of showing you could do a similar thing on USB in terms of like a flag target, and our target would be way down there. What's our ATR on this? Well, it's about 1.6 almost, okay? 1.6. So what that means is, on average of late, this has moved about $1.6. Now, you may be trying to do the math here on this and go, well, my range on a particular day is something. You can't just use the range. It's not just the average of the range. I know you hear the words average true range, and you think it's just the average of the day's high to low. But the ATR actually takes into account gaps like this, where if you look at this day's range, we'll go like here, right here, this day's range would not include the gap on there, okay? Would not include a gap on there. So the ATR includes those gaps. So you can see what it is, and you can say, well, if I want to do a target, I'm going to use this level, whatever that level is, as a potential target, or we use it for stop losses as well. Where should I put my stop? You can use an ATR in that. If you take a more expensive stock, let's take Netflix for a sec, that ATR is obviously going to be more on a more expensive stock because a similar percentage move is a bigger amount. Here we have ATR about 40 on that. You can see that right up there, about 40 on this there. So that's how that works. Now, how do we just do one ATR target? Well, you can. You can also do multiples of that. You can do two ATRs. What would be two ATRs at Netflix? Well, it'd be about $80, right? What would be a half an ATR on Netflix? A half an ATR on Netflix would be about $20. That's obviously an extreme number, but let's go back to AbbVie here, okay? Because I want to give you some examples. I want to give you both bullish and bearish examples with maybe different targets, ATR or stops. Maybe we'll use something different on there. And in the chat, CP said, well, what about other? Yeah, there's a lot of other different ways to come up with targets or things. You can even use a percentage or dollar amount if you wanted to. There's nothing wrong with that. What's our current ATR? Our current ATR is about 6.7. I'm just going to write that down. Now, of course, all this is predicated upon a chart that you think you're willing to make a forecast on, whether that's a bullish forecast or a bearish forecast. If you don't think the stock's going to go up, then you want to do a long call. If you don't think the stock is going to go down, you want to do a long put. In this case, my assumption is we have a trend here. It pulled back, kind of flagged, pulled back, is giving us kind of a bearish engulfing candle today. You see that? When the body of this candle is a red candle and it's the closing price, or excuse me, the opening price up here and the closing prices here totally envelops the previous day's body of that candle, then we call that a bearish engulfing candle, which some traders will use. Some traders will use as a bearish indication there. Okay, so here's AbbVie. what I'm going to do here is instead of doing a target like the flag target down there, what I'm going to do is I'm going to take my ATR, which we said was about 6.7, and I'm going to use that as a target on the stock, okay? 6.7. Well, I'm going to take the current price, which is 179.50 minus 6.7 is equal to 172.80. Okay, that's my target. That's my 1 ATR target on this. All right. So that's going to put the target about 1.7. I'll just kind of go on the screen. Right about where my cursor is where our target is. You can see that's not a huge move on this stock. Given this stock, given the amount of movement we've had, it's not a super ambitious target. It's going to get us out quicker probably. And similarly, if we want to maintain a reward to risk ratio, we probably want to keep our stop in line with that as well. Well, what's my stop? Well, one way to do it, you can use your stop, and we'll look at examples of triggering the stop or an exit based on price action here. But in this case, in this first example, what I want to do is I'm just going to kind of shoot for a 2, it's supposed to be a 2 to 1 reward risk. Now that's going to be on the stock. We're actually going to be placing an option on here, but if you have a 2 to 1 reward to risk on the stock, it may not be exactly a 2 to 1 on the option. Certainly, that may not be the case, but it's probably in that ballpark or close enough to it. All right. Okay. Now, CP said 7-day or 14-day. This is the default 14-day, which is what I'm planning on using here, everyone, 14 days. Can you switch that? Absolutely, you can switch that. If I were to use a 7-day ATR here in this case, though, this is a good example. I'm glad you brought this up, CP. What's it going to be? It would probably be higher than this right now. I mean, right now it's 6.7, but if you're just going back 7 days, you're picking the 7 of the more volatile days here. That's really when the volatility kicked up there. Okay, so you can use either. I don't have any strong feelings on that, to be honest. Another thing, this is a shorter term trade. This is actually a dividend, but if, let's say there's an earnings coming up, you may consider earnings, but it's going to be, presumably we're going to be able to achieve our target quicker with the tighter target using the ATR than if we were going to do a bigger target where it would probably take more time to achieve that. So we're more likely to be able to get in and out before earnings in that case. Now, this is all for naught if the stock doesn't go our way, but that's the risk we take. So let's do a half an ATR target here on this. So we said 1 ATR was 6.7. I'm going to take 6.7. I'm just using a calculator here. You just could probably do this one in my head, but I'm going to divide that by 2. And a half an ATR is 3.35. I'm going to add that to the current price, which is 179.36 plus 3.35 gives me a 182.71. That's going to be our exit on that. Okay, those numbers are based on the stock price. Well, let's do it. Let's put in a trade here. I'm going to go here. It's a shorter term trade, so I'm not going to buy that much time on this. I'm going to go to my option chain. Here's my option chain. I'll go out a few weeks. Maybe this takes a few days to get there. Maybe it takes a week to get there. I want to go there plus maybe a couple weeks. I'm going to go to the 24th. Now, our time decay is probably going to be fairly high in this, but we're not planning on being in the trade for that long. So that may not be that big of an issue. Another thing we may check is, what's our open interest on the trade? Well, open interest is a little bit thin on some of this. Oh, actually, we're doing puts here. We're going to look over our put side. And it's not, that's okay. Bid-ask spread, not great. So for that reason, I may look for some different trades. In other words, I'd rather buy a little more time than I need in order to get contracts that are more liquid contracts. Let me just check out there. Well, we have a lot more contracts there on this. Our spreads are a little bit better here on this. Let me just go out. Let's look out just a little bit. That's probably going to be even less. It is. Let's do this. Let's go out a month here on this. We'll go out to the regular monthly contracts. And here we have more open interest and tighter spreads. And I'm just going to go at the money, basically. I'm going to do the 180. It's about a 50-cent bid-ask spread here. It's moving on me here. But it's a $10 option. This is going to cost me about $1,000 here to do this. What I'm going to do is I'm going to right-click on this, and I'm going to buy custom with stop. Okay? I'm going to buy custom with stop on that. And I'm going to buy this, at the current price, but I'm going to get out. I'm actually not going to put our exits based on the option price, because that's what we're seeing right here, right now, right? This is all based on the option price. Buy it at 1020, that option at 1020. The default here is $1 less than that 920. I'm going to make this a market order. I'm going to make it good till canceled. I'm going to click on my gear, and I'm going to put in my exits. I'm going to say if AbbVie marks less than or equal to, this is going to be our target price, less than or equal to 172. This is why I wrote it down earlier, because I would have forgotten this by now. 172.80. Or, now you're going, where do I click? Where do I put this in? Just kind of put your cursor down there and it will highlight that line. You can't see it if you have this right here. But once I put my mouse down there, you can see it's down there. And all I need to do is click in there, and I'll automatically fill in the underline of the stock we're on here. And marks greater than or equal to, and we said 182.81. Okay, there we go. Let me save this. And this is not technically a stop. This does not mean we're going to get out. This doesn't guarantee any prices in terms of what the option is going to be when we get out. But we know we're starting off with that 2-to-1 reward to risk ratio on that. Okay, and let me go here. I'm going to see if I can get a little better price than that mid price, than that natural price right there. Single options on Thinkorswim. Single options, it's going to default it to the natural price. When you start doing spreads, it will default it to the mid price. Realistically, you're probably not going to get filled right away at the mid price. Realistically, there's a good chance you'll be able to get a little better price than the natural price. So going in between those is kind of, you'll see me do that quite a bit in this webcast. I'm going to confirm and send this order. And of course, how much can I lose on this? I can lose the whole thing, $1,000 here on this. So there's no guarantees that I'm going to get out. The stock could certainly gap up here. Long single options, we're going to send that order, and we put that in, and indeed that did fill there. Okay, let's look at some other examples, and I'm going to tweak them up just a little bit. I'm going to mix them up a little bit. I want to give you bullish and bearish examples. Let me give you a bearish example. Let me give you a bullish example here. Then we'll go to another bearish one and illustrate some different things, because I want to illustrate different ATR levels and also maybe using the ATRs with non-ATR stuff as well. Here's a bullish example that I'm going to look at. Now, yes, this dropped down, but really there's not many stocks that haven't dropped down. But what you're going to see is this actually is hanging on to a gain today. This is a nice little gain today. Our candle's slightly green, mostly, kind of almost a doji there, but it's holding that moving average right now. We're gonna go with the bounce theory on this, that we pulled back, we maybe overshot, and now we're going to be a little bit more bullish on this. What's my ATR? Well, it's a lower price stock, $69 stock. And of course, this isn't just, the level of the ATR isn't just in accordance with the price of the stock, it's how volatile it's been here. So right now we're at about 1.63 is our ATR. So let me just jot that down, 1.63. If I take my, and this is a bullish trade, if I take that as a target, I'm going to take 1.63 plus the current price, which is 68.96, gives me a 70.59 target. And if I were to do a half an ATR stop, I could do that. The other way I could do it is I could say, well, look, this is bouncing. I'm going to go below today's low. Okay. Now, Frankie said, hey, we have earnings on 4/29, which in this case is fine because the reality is, remember, our target here is $70.59, right about where my cursor is. It would be highly unlikely if this stock doesn't either go down more and get stopped out or go up more and that it kind of just stays in this little tight range between now and earnings. So that is not going to discourage me. But here's my point. On the first example, we used an ATR target and a half ATR stop. In this case, I'm going to go down below today's low, and I'm going to go maybe 1% below that. I'm going to go a little bit of gap below that, and I'm going to say that's where my stop is going to be. If we start to reverse, break down below our lows and then some, then I'm going to get out. So I'm going to go to today's low. I'm going to calculate 1% below that. So let me get out of my little drawing tool. I can figure out today's low. I just hover over the mouse, over the candle, and I'm going to look up here. It says O for open, H for high, L for low. When I'm on that, the low is 68.68. 68.68. Okay, so I'm going to go 68.68 times 0.99 gives me 67.99 as my stop level here. Okay, basically $68 stop. Let's kind of consider this from a reward to risk ratio here. Okay. We're roughly, I'm going to, just to make the math easy, I'm going to round up a little bit here. I'm going to just go, the stock's about $69. We said our target is going to be $70.59. Okay. Our stop is going to be $67.99. Kind of a standard thing that many traders do is they look to say, hey, I want more on the upside than I do on the downside. Now, of course, that downside, we're not guaranteed to get out exactly at that point, but that's that. Okay. Binahar says, or Binjar, I'm not, apologize if I'm saying that wrong, says, do we consider the break even? Look, this is a long call that we're looking at. The break even is going to be a little bit below. We need the stock to move our direction. Okay, so the break even is going to be a little bit below where the current price is. The break even at expiration is basically going to be, we got to look at the options to do that. We can look at the options, but basically it's going to be the strike price minus the initial debit. That's going to give the break even. For our calculation here today, the answer is no, we're not going to consider the break even in this case. But you could. It's not a kind of a standard thing I would do in this case, though. Okay, nothing wrong with it there. Okay, so we have our target, we have our stop, we have our reward to risk ratio. Again, let's go here. Let's just see if we got something maybe a little bit more. Here's our open interest. I'm going to go right at the money. We'll go $69 and probably tight enough on the bid-ask spread there. I'm going to right-click on this. I'm going to buy custom, and I'm going to do let's do an OCO. Well, yeah, before I did a stop and I did them both on the same line. That's probably easier. I demonstrate the other quite often, so I'm just going to do that again. Okay, so here's my entry price. Stop, we're going to change that. We're placing these based on the option, on the underlying stock price. So I'm going to go here. And notice, where do I click? I don't see anything down here under symbol. Remember, you got to highlight it to do it. So Coke, Marks, greater than or equal to, this is going to be our target if the stock goes up, 70.59, 70.59. And I'm going to click down here if it marks less than or equal to, for some reason that didn't take. Let me try that again, 70.59. Let me click my enter key. Sometimes it's a little finicky, I found on Thinkorswim on that. You just got to make sure you click that enter key a couple times. Sometimes it takes, it seems like. 67.99, okay? And there we go. So that is an example of a bullish trade based, again, I'm going to go between my mid and my natural price. We'll do that. This is an example of a bullish trade. And of course, you can ramp up the number of contracts. I just have one contract here, okay? You can ramp that up. Just realize your risk. What's your risk? Risk is about $200 on this, okay? About $200. So if you want to risk a little more, you can do more than that in terms of contracts. Confirm and send. And this is long single options, and we're going to send that. So that's an example of one where we're doing an ATR target, and our stop is just based off a technical, a gap below the low price of that. I just did a percent gap. You're not stuck to doing ATR on all these. Now, you're not stuck to one ATR either. Let me give you another example here. Let's look at Dow, okay? So this is Dow, the company, not Dow Jones Industrial Average or anything. I'm going to call this a bearish trade. Our trend is going down. We fell down, and then today is just a terrible day. I mean, for a lot of the market, it's actually recovered quite a bit today after this is showing no recovery. I mean, it's opened up higher, but we're down 5% now. And by the way, I don't know where the market's going. I don't know about this particular stock, and I don't know where the whole market's going, but I think it's most people are expecting quite a bit of volatility, whether upside or downside here going forward. So here's what we're going to do. We're going to take this. Now, one ATR is what, about 1.5. Well, maybe I want to do more than that. Is that possible? I could do, yeah, maybe I do 2 ATR target. Okay. One ATR is 1.55. That's going to make 2 ATRs 3.1 is going to be 2 ATRs. So where would that give our target on this for a bearish trade? Well, we're right about 26 right now. 3.1, if I take 26.03 minus 3.10 gives me 22.93. Now that's a fairly big target. In fact, normally I'd say that's a big target, I guess. But given the volatility, where we dropped 5% today, we've dropped 5% a couple other days recently, that's certainly not out of the realm of possibility here on this, okay? So maybe it makes sense. My point is with this is this: you're not stuck. You are not stuck with a 1 ATR target. Question in the chat: where did I get 3.1 from? Well, our ATR right now is 1.55. 1.55 times 2 is equal to 3.1. I'm doing my math right there, aren't I? Okay, so that's my 2 ATR target. So when we're looking at these, if you're doing something that's like a 0.5 ATR target, that's going to be very close, and you likely would, there's a good chance you're going to hit that within a day or two. Okay, a 1 ATR is a little bit bigger. There's a chance you'll hit it in a day or two. It may take a few days. 2 ATRs, it may take a week or two. Maybe not, but it's going to take a little bit longer. So you can always ramp these up. You're not stuck to 1 ATR, is my point on that, okay? So let's do this. Let's go to Dow. I'm going to go a little bit longer term. I'm going to go, for liquidity's sake, I'm going to go out here too. And we're doing a bearish trade on this. I forgot to do what about our exit? Well, I'm just going to do I did a 2 ATR target. I'm just going to do a 1 ATR exit. So I'm going to take 22.93 plus 1.55 gives me 24.48. Okay. So let's do it. Well, let's do it. I'm going to go to at the money. Where are we at? We're at 26 bucks. We're kind of in between the two, aren't we? Which one's at the money? In theory, the at the money contract is the one that is closest to the current stock price. Stock price is at $26. We're a little bit closer to this one. So this is out of the money, right? But it's also the at the money contract. This one's in the money. Okay, this one's in the money. So I'm going to, and we've examined this over the past few weeks some in terms of being more aggressive. There's pros and cons. If I go out of the money on these, like in these contracts, okay, out of the money, it's all extrinsic value. It's probably a little more leveraged, a little more aggressive is how a lot of traders will treat them. And what if I go in the money a little bit? Well, if you go in the money, then it's maybe a little less leveraged, but it's going to be more expensive. So what I don't want you to do is think, well, I just want to get the cheapest contract possible and go down here necessarily. If the stock moves a long ways down, yeah, this possibly could pay off to go way down there. Okay, there's zero open interest right now, but it possibly could pay off if the stock just completely craters. But that is a more aggressive stance there on that. So there we go. So I'm going to actually go in the money just a little bit on this. I'm going to go to the 2750. I'm going to right click on this. I'm going to buy custom with stop. Well, I'll do the other way. You could do exactly what we did before, but let me just show you it this way. First triggers OCO. This first order, these second orders, the second and third orders are only going to trigger if the first order fills. Okay, these are irrelevant unless that first order fills. Then they both become active, and if one hits, it is filled, then the other will cancel, and vice versa. So I'm going to do this. I'm going to make this good till canceled. I'll make them both good till canceled here. I'm going to make them both market orders. And when you do that, it's going to give you a little error message. It's going to say market order must have a daytime in force, but we're going to put some rules on that, so that won't be necessary. I'm going to click on that gear. I'm going to do the same thing before. I'm going to say if it marks less than or equal to 2293, 22.93 is, hold on one sec. Let me double check my math on that. I did my 22 point, that looks right. Oh, I did my target wrong. Excuse me, my stop wrong. I want to take current price, 26.09, and add on the 1 ATR, 1.55. I subtracted it. So that would be 2764. 2764. Okay. Let me go back to where we were. Sorry about that. I already did this one. This one I think was correct. Dow Marks less than or equal to 2293. That's my two ATR target. Here's my, I'm calling it a stop. It's not really a stop. It's just a contingent order. It's a rules-based order to get me out if Dow Marks greater than or equal to 2764. 27.64. Okay, let's save that. How much are we risking on this? Well, we're risking about $300 on that. Again, if you want, you can adjust the quantity and go, well, I want to do 2 of each of these. Okay, there we go. I'm going to click up here. I'm going to split those 2. I'm going to confirm and send. I'm going to put this in my long single options, and we're going to send that order, and that filled there. Okay, so now we got 3 trades. I'm not going to go through full examples of others, but let me just kind of talk to you some others that I was going to, you could potentially, just example type things. For bullish trades, again, most of the market is pretty bearish right now. The general trend has been, this has not fallen down as much as it can. If you see a bounce occur, we're down about 1% almost right now. But if we get a hold or a bounce or something, some traders may consider that more of a bullish, just from a technical standpoint, their trade. Let's look at another potential type example. Here's AMD. Here's AMD. Again, looks like it went down, kind of flagged, went down, maybe flagging. We'll have to see. That is looking a little bit more bearish. And yeah, I think that's it. Okay. Let me just kind of recap here and remind you that you can always find our webcasts on Trader Talks channel on Schwab. If you are, on Trader Talks channel on YouTube. If you're looking at YouTube, bottom right portion of the page, if you have not subscribed, you could kind of put your cursor over there and it says subscribe. You can subscribe. If you've already subscribed, don't do that because I think it unsubscribes you. But that's a way of finding our webcast there. One webcast I would encourage you to hit up live. I mean, these are great. I'm happy if you're watching a recording, but there's one webcast in particular I'd encourage you to hit up, and that's on Mondays at 4 o'clock Eastern Time. We have a Trading ETFs webcast, and that is not recorded. Okay, so you got to hit that one live. 4 o'clock Eastern Time, Monday, Trading ETFs. We talk about ETFs, which is great. Connie Hill teaches that class. Make sure you check that one out. So we talked about smaller gains today. Smaller gain. Not going for these big, not swinging for the fences so much, but doing smaller gains. And kind of the standard that we talked about was using that average true range as a way of getting us, to a potential place to target there based on the stock price. We also mentioned you can use a half an ATR target. Just take your ATR, whatever you see over here, about 5.5 there on that, 5.5, and divide it by 2. That's going to give you a half ATR. And we also talked about using a 2 ATR target. And to keep in mind, keep your reward to risk ratio in mind. It does not mean, I'm not saying you need to have a 2-to-1 reward to risk ratio, but most traders like to keep that positive. Maybe it's 1.5 to 1, maybe it's 1.75 to 1, maybe it's 3 to 1, I don't know. But keeping that reward to risk ratio positive is a very typical way we go about this thing in this class. Also, you're not stuck to using ATRs. We did ATR entries, and then we also said, hey, if it goes below the low of the day, that's another way of potentially exiting. These are all based on the ATR of the underlying stock, not the option. Hopefully that is helpful to you, everyone. I want to let you know, coming up next, we have getting started with technical analysis. Getting started with technical. If you feel a little weak on your technical analysis skill, or you're newer to technical analysis, that is an absolutely wonderful way to get acquainted with that. And so, they're going to talk about trend and support and resistance and different price patterns and stuff like that in there. So that's coming up next. All right, everybody, thanks for taking some time out of your day and joining us. Thanks to our production staff for your help, and thanks to Connie. Everybody have a wonderful rest of the day. We'll talk to you later. Bye-bye, everybody.